You ever hear something that sounds so practical it almost feels like poetry? That's how I felt reading Landturner's newest piece. I mean, yes, it's about yield max funds and return of capital and NAV erosion. But it's also kind of about life, about not throwing out what still works, about honoring the machines that have paid their dues. I'll be honest. When I first heard NAV erosion, I pictured my espresso machine slowly leaking dignity. But leave it to Mr. Turner to come in with a story about CD burners and business floor wisdom, and somehow make me rethink how I treat every part of my portfolio. And maybe a few parts of myself. So grab your coffee, or clean out your mailbox, because this one's got a little more zen than usual.
Welcome to the Deep Dive. Ever wondered if your investments could feel, less like a gamble and maybe more like a well-oiled business? Today, we're taking a deep dive into an article called Zen and the Art of Yield Max Maintenance. It's by Lan H. Turner, editor-in-chief of Pitt News Magazine. And it really challenges how we view high-yield funds, especially things like yield max. Turner kicks things off with this anecdote that I think immediately resonates. It's from his past in the software world. He talked about these sort of unsung heroes of his old company, physical machines that duplicated and labeled thousands and thousands of CDs a week. They weren't glamorous or anything, but they were the lifeblood, just churning out revenue.
Yeah, and what's really fascinating there is how the article takes that really practical business owner mindset and applies it straight to investment portfolios. Specifically, it dives into those common anxieties people have around funds like yield max, things like NAV erosion, return of capital, and it clarifies them through this really unique lens. And just for context, yield max funds are these innovative ETFs, right? Designed to generate high income, often using covered call strategies on popular stocks. They're built for cash flow, which, kind of challenges those traditional ideas about just watching the portfolio value go up.
Exactly. So our mission today is really to unpack this fresh perspective. We want to draw out those aha moments that can help you understand your investments, not just as numbers jumping around on a screen, but as like productive assets, just like those old CD duplicators he talks about.
Okay.
Let's dive in. So Turner opens with this story, right? His company relying on these physical machines, real workhorses, constantly producing revenue, even though they were getting older and naturally needed some maintenance now and then. They didn't just junk them because they weren't brand new.
And the key insight, the real takeaway from that analogy, is that in business, you don't just toss out a working machine that's making you money just because it's showing somewhere or isn't the absolute latest model. You maintain it, you repair it, maybe you add another one alongside it if it's still generating value. And the article basically says, apply that same logic to your investments, your investment machines.
Right. And he mentions this whole perspective kind of crystallized for him after readers pushed back on an earlier piece he wrote, Think Like a Business Owner. They were specifically worried about, NAV erosion in yield max funds like TSLY, YMAG, MSTY. People were basically asking, hey, aren't these machines just breaking down? Isn't the value falling apart?
Which raises a really important question for all of us, I think. How do we genuinely shift our thinking? How do we go from being just a sort of passive investor to an active operator managing our portfolios? The article really argues that understanding things like NAV erosion and return of capital or ROC from that business owner's viewpoint, well, it changes everything.
And that brings us to a part I found really, really eye-opening, especially about something that scares a lot of investors, return of capital. All right, it's one of the biggest misconceptions, isn't it, about yield max and maybe other income ETFs too. People are like, oh, they're just giving me my own money back. That's not real income.
Yeah, and this article just reframes ROC brilliantly. Most investors get the difference between return on capital, that's your profit, the extra value created, and return of capital. But where it gets really interesting is the argument that ROC isn't some red flag here. For these types of funds, it's actually a deliberate design feature. It's the business, the fund, returning part of your original investment as cash instead of keeping it all locked up in the net asset value, the NAV.
Exactly. Turner emphasizes this is by design. These funds are built specifically to provide that consistent monthly cash flow. So if maybe there's not much profit in a given month from their trading strategies, the fund might return a bit of your original capital just to keep that cash flow steady, to help you, cover expenses or whatever you need the cash for.
It's such a crucial point he makes. ROC isn't erosion. It's the machine pulling its own weight. That's a powerful way to put it. And let's not forget the tax angle either. The article notes that ROC, because it's essentially your own money coming back, isn't typically taxed as income. That's a pretty big deal for investors.
Definitely. So what does this mean for you, the person listening? Well, if you don't need that cash right away, the article suggests reinvesting it, but strategically. Treat it like a new allocation decision. Don't just automatically DRP it back into the same fund without thinking. It's about reinvesting with intention, right? Like deciding to buy another productive part for your factory floor.
Right. Intentionality is key.
Okay, so let's tackle the other big anxiety. Seeing a yield max fund's share price go down over time. That often triggers that immediate reaction. Uh-oh, the NAV is eroding. The machine must be broken.
And the author counters this so well. He basically asks, what machine doesn't wear down with use? I mean, think about it. In any business, every single asset depreciates. Your delivery truck, a factory press, those CD duplicators he mentioned, it's just normal. It's expected. It's not failure. And the article puts it bluntly. NAV erosion isn't destruction. It's depreciation.
Yeah, that's a great line. He really drives home the point that you didn't buy these investment machines to flip them for a quick buck based on their resale value. You bought them to produce, to generate income. So the real question isn't, oh no, what's it worth on paper today? It's more like, okay, has it paid for itself yet? And how much has it earned me since I put it to work?
And this leads right into another brilliant concept from the article, the payback period. It's so simple but powerful, just the cost of the machine divided by its annual output. He gives this really clear example. Say a $10,000 investment in TSLY generates $11,000 in distributions in a year. Well, that machine paid for itself in under 12 months. After that point, every single dollar it spits out is what he calls pure income. It becomes a cash cow or a gravy train. That fundamentally changes your emotional connection to the asset, doesn't it? It's not just, oh, it's down 10%. It's, hey, this thing paid for itself already, and now it's just making me money.
It really does shift your perspective. So just like any physical equipment in a business, every investment machine, well, it reaches a decision point eventually. The article challenges you, as the business owner, to think about it. Do you fix it? Do you feed it? Or is it time to retire it?
And I love the perspective here. There's no shame in retiring a machine as long as it earned its keep.
That's quite liberating, actually. So fix it means maybe reinvesting in the same fund. If the NAV dropped, but the underlying strategy is still solid, the income's still flowing, maybe reinvestment is just like necessary maintenance to boost future output.
Okay.
Then feed it means adding new machines, new funds. If one machine is working well, maybe you diversify your factory floor, add APIY, NVDY, AMZY, GOOY, whatever fits, each one generating cash flow from a different source, just like a real business expands.
Makes sense. Diversification. Exactly. And finally, retire it. Sometimes a machine just stops performing well. Maybe the underlying stock is in a long downturn or the income drops off significantly. The article says it's okay to shut it down, take it off the floor, but again, ideally after it's earned its keep. And he acknowledges, look, not every investment is a winner. That's just market reality, he says, not specifically a yield max problem.
Right. So the big takeaway here isn't to fall in love with the equipment, the specific fund ticker, but to fall in love with the output, the income stream it provides. That's a really profound shift for a lot of us, I think.
Absolutely.
And the article really hammers home a basic business principle, doesn't it? If you don't measure it, you can't manage it.
Yeah.
Every serious business tracks its performance like crazy. And you, as the operator of your investment factory, you really should too.
Yeah. Each ETF in your portfolio is a business unit, a machine. Track it like one. That's the advice. He suggests using a simple spreadsheet, not just for taxes at year end, but actively tracking what did it cost, how much has it returned, like cumulatively. Is the trend generally up or down? Does reinvesting make strategic sense right now?
He even lists the specific columns he uses, which I found helpful. Share count, your purchase price, the monthly income, that cumulative output number, current NAV, yield, and importantly, calculating that payback period.
And what's really powerful about doing this, the shift it creates, is that, as he puts it, once you start tracking, emotion gets replaced by data, and that's when you go from investor to operator. It lets you manage proactively instead of just, reacting emotionally to every market swing.
Totally. So the article wraps up with this really powerful mindset shift, almost like a mantra. If you want mailbox money, treat your mailbox like a revenue center, not a scoreboard. I
love that. That's so good. Investing in these kinds of funds isn't just about watching prices wiggle around. It's fundamentally about managing production, managing the output, Just like those profitable old CD duplicators stayed on the factory floor because they produced, your portfolio should be managed for what it generates, the cash flow.
Yeah, he really brings it all together. Track the output, maintain the system diligently, add new machines when it makes sense for your production goals, and be decisive about retiring the ones that just aren't delivering anymore.
It's not just investing theory, is it? It's adopting a true business owner's perspective. And business owners don't bet, he says, they build.
So if your goal is financial freedom or just consistent cash flow, that mailbox money he talks about, the message is stop watching the market like it owes you something. Start operating your portfolio like it works for you because, well, it can.
And he leaves us with 3 really concise, powerful points to drive it home. 1, mindset matters more than almost anything else. 2, discipline wins consistently over time. And 3, if you actually treat your mailbox like a revenue center, not like a scoreboard just checking the score all the time, you'll be amazed how quickly those numbers can add up.
Mailbox money isn't luck, is it? It's something that's built, brick by brick, trade by trade, month by month. As he says, you don't wait for it, you construct it.
Yeah, it's not magic. It's not some miracle. It's a machine. And it works when you work it, when you apply that business owner discipline. Most people check the mailbox hoping for good news, right? But as he puts it, builders check it expecting results. There's a big difference there.
Wow. What a deep dive, really shifting that perspective from just being a passive investor to being an active business operator.
Yeah.
The whole idea of viewing your portfolio as this collection of revenue-producing machines rather than just assets bouncing around with market whims, it really changes the game for how you approach income investing, I think.
Absolutely. And if you connect that to the bigger picture, it really encourages a much more disciplined long-term approach. You're focused on sustained cash flow, on production. You're less likely to get whipsawed by short-term price noise. It challenges us, to actively manage, to measure, and to make those strategic, data-driven decisions about our financial future.
So thinking about this, what does it all mean for you listening right now? Maybe consider how adopting this business owner mindset might fundamentally change how you track and interact with your own investments. Would using even a simple spreadsheet, like he suggests, help transform those emotional gut reactions into clear, data-driven decisions?
Yeah, and maybe take it a step further. It raises an interesting question for all of us, really. What other machines in your life, maybe beyond just investments, could benefit from this kind of thinking, this fix it, feed it, or retire it approach? And that shift from just passively hoping for results to actively expecting them because you're managing the process.
That's a great thought to end on. Thank you for joining us on this deep dive. Until next time, keep building.
So, lesson learned. Just because something's not shiny and new doesn't mean it's broken. If it's still producing, still putting in the work, you don't junk it. You respect it. You maintain it. You run the numbers, you clean the filters, and you show up like a business owner. Honestly, if I treated my emotional health like Land treats his yield max strategy, I'd be unstoppable. But for now, I'll just say this. I'm rethinking what it means to retire something and what it means to reinvest. And not just with money. If you're managing your own yield max machines or just trying to figure out what the heck return of capital even means, Land's got you covered. You can read the full piece at pitnews.com. Or just keep listening. And if you're still not sure what to do with your underperforming espresso machine, don't worry. I'm keeping mine. It still makes magic when it matters. Catch you next time.